Hi guys, welcome to my videos. So guys, as the housing market across Canada is getting hotter every day, I thought of making a video about mortgages. Yes, like most of the people cannot buy a house on cash. So that is why I thought it's important to make a video like this where I can give you simple information that's going to help you to select the best product. I'm not going to do mathematics and calculations in this video, but to let you know that what exactly they are. So before I proceed further, if you have not already subscribed to my channel, please go and subscribe right now. So guys, I want to clarify that neither I am a mortgage broker, nor I am a lender, nor I am any professional related to mortgage or financial industry. So whatever I tell you in this video is based on my personal research and analysis, and it could be proved wrong. So if you take anything out of this video, you do it at your own risk. Alright guys. So there are two types of mortgages we get, variable and fixed rate. Now we are going to discuss what they are in this video. So we'll go with the first one, fixed rate. So as you heard it correct, fixed rate, where your rate of interest is going to be fixed for your term. It could be anything like, let's say 2.5, 2.6, 3.6, whatever. These things keep changing based on the prime rate um, uh, set by the Bank of Canada. But once your mortgage is locked, regardless of the prime rate or regardless of the rate changes, whether it goes up or down by the Bank of Canada, your rate of interest is gonna stay the same. So it does mean that your monthly payment remains same except for house tax. I will explain you what it is. So when you pay your mortgage payment, basically there are two things. One portion of it goes to your lender towards your um, principal and interest. Okay, like the money you have borrowed from your lender, it could be a bank or any other institution for repaying the loan that you have taken off. Okay, but there is a second portion also. So this is not mandatory, but most of the people take it, like you have to pay your house tax, right? So why would you like to go to the city and pay this when your lender can do it themselves? So this can vary because the city can increase the tax or can make adjustments. So a very small number can vary every year. If your city increases the tax, this can also vary. So this is why I have said, but don't consider it like varying uh, varying in a way that it's so high. It's not like that. Okay, but yes, a very small number can vary because of the tax, but the other portion that goes towards your lender is fixed, and that is why we call it fixed payment. All right, next is the variable rate. So now we need to understand that what exactly you mean uh, variable rate. So variable rate is what, like there is a prime rate that is defined by the Bank of Canada. Let's say it's 3.5%. Now when you apply for your mortgage, after looking at your profile, your lender can offer you a discount on your prime rate, let's say 0.5%. So that means your effective rate of interest 3%. They can even increase also in some scenarios, but mostly people get a discount. It could be anything and it varies a lot. So let's say you have got a discount of 0.5%. So out of this there are two components. One is the prime rate set by Bank of Canada. Second is uh, your discount that is offered to you by your lender. Fine, you are paying 2.5 now, like 3% prime rate and 0.5 discount. Fine, 2.5. But next year Bank of Canada may increase the prime rate. If it goes to 4, like if they increase it to 4% from 3, then your rate of interest is gonna be changed to 3.5, because now the prime rate is 4, and you are getting the discount for your term. Like term is generally 5 years, so that is like for your term it's gonna be like 3.5. But on the other hand, if they decrease it, like let's say from 3 they make it to 2, then you're gonna pay 1.5%. So that is why I have written the points. Your payment can vary depending upon your term, during your term, based on your prime rate. It could go up and down, and it could I mean all possibilities are there. So when you select a mortgage, you need to carefully plan with your financial advisor or mortgage broker. They will be in a very good position to tell you about the current market rate and what is expected. When you go with the fixed rate, you are more or less uh, worry free, because you don't worry about the prime rate if it's going to increase or decrease. When you go with variable rate, you have the option, or you have the possibility, I would say, of paying lower amounts if the prime rate is on declining. Like if the current market trend and the situations make the government to reduce the prime rate down the line in next few years, you're gonna be benefited. But what if it increases? Then you have to pay more. So these points you need to consider, and you can take a good decision only um, if you are an expert, or if you discuss with an expert. And definitely I am not an expert. So if you ask any questions related to that in the comment box, I won't be in a position to answer them. So this is how it works, guys. So thanks for watching the video.